Yeah. Hi, hello all, happy morning. So in this session, we are going to discuss about the amendments which is applicable for this June examination. So the purpose of this entire class, that is the amendments and the Super 30 class, is just to give a last minute push to your preparations of your taxation paper, both direct and indirect taxation. Right. So just before getting into the problems, so if we tackle all the amendments, whatever is there, whereby there is majority of the questions which is going to be put, it will be easy for us to handle this in examination, both in the MCQ parts and also in the questions part. So this is the idea behind this. So firstly, we'll take up the supplementary paper which is released by CMA Institute for us to understand the amendment. And in the next thing, we'll discuss about the questions, the Super 30 questions. Okay. So the first amendment which will come in every finance. So basically, if you see, this is all the amendments which has come by Finance Act, July Finance Act, July 2024, there was a Finance Act. So whatever amendments was pronounced by it, it is applicable for our examination. Okay. So the assessment year which we are going to deal here is assessment year 25-26. So the first is going to be the rate of income. So as you all know, there are two types of two rates for taxation. One is the old tax regime and the other one is the new tax regime or the default tax regime. Okay. So as far as a new tax regime is concerned, that the default tax regime, everybody who is going to pay tax is automatically into the default tax regime. And if you want to opt for the old tax regime, you have to specifically file a form and opt in for paying tax under the old tax regime. The difference between the old tax regime and new tax regime, there are two differences. First one is going to be the rate, and the second one is going to be deductions. Multiple deductions, it is not available in the new tax regime. However, the rates will be lower. Or you can take the deductions in old tax regime. Generally, the rates are higher in old tax regime. So the first rate which we are going to see now is the new tax regime or the default tax regime. In the default tax regime, the rate which is applicable for assessment at 25-26 is going to be up to 3 lakhs, it is going to be nil. 3 to 7 lakhs, it is 5%. 7 to 10 lakhs, it is 10%. 10 to 12, 15. 12 to 15, it is 20%. More than 15 lakhs, it is 30%. So basically up to 3 lakhs, it is nil. From 3 to 7 lakhs, it is 5%. So if we just check for the rate here, it is somewhere around for 4 lakhs, it is going to be 5%. So 4 5 it is somewhere around 20,000 for the first lakh. Next 7 to 10 lakhs, it is going to be 10%. So here the gap is 3 lakhs, 30,000. So in the first place for this, it is going to be 20,000. 20,000. For this, it is 30,000. So whenever you are computing, if you can just take, assume for example, if your income is somewhere around 11 lakhs. So what you can simply do is 50,000 plus whatever is the rate in the last slab, you can do that. So next is 10 to 12 lakhs. For 2 lakhs, it is going to be 15%. So it is going to be 30,000 again here. 30K. And the last is 12 to 15 lakhs, it is going to be 20%. For 3 lakhs, it is going to be at a 20%, which will be 60,000. So more than 15 lakhs, you have 20%, 30% slab rate. So here next question which will come into play is what is going to be the rebate which is given under 115 BAC. So under 115 BAC is the section which deals with default tax regime. So if you see the quantum of rebate which is given under section 87A, the quantum of liability, it is going to be 100% of the tax computed above or 25,000 whichever is lower. And this rebate is applicable only if your total income which is chargeable to tax is up to rupees 7 lakhs. So if the income is going to cross 7 lakhs, you have to pay tax from 3 lakhs. But if your income is till 7 lakhs, you need not pay tax. The rate of tax is not changing. The rebate alone is being changed. If you see here, we just saw that for 3 to 7 lakhs, the total amount of tax which is going to be paid is 20,000. But the quantum of rebate is 100% of tax liability or 25,000, whichever is lower. So even though you have the cap of here, if you see the quantum, it is 25,000. But till 7 lakhs itself, the tax which has to be paid is only 20,000. So this amount might not be useful at multiple places. So whatever is going to be your 100% of tax liability, whatever you have computed till 7 lakhs, the same amount you are eligible to claim it as rebate if it is normal income. Okay. Next point is you also have a marginal relief. So marginal relief is basically when you earn the income which is more, sorry, you pay tax more than the amount what you earn. So assume, for example, if your income is 7 lakhs 1,000, okay, your income is 7 lakhs 1, not even 1,000, 7 lakh 1. So if your income is 7 lakh 1, what is going to be your total tax liability? So for 0 to 3, it is going to be nil. 3 to 7 lakhs, you are going to pay tax of 20,000. Plus for this 1 rupee, you are going to pay 3 paisa, 0.3. Okay. So you are going to pay rupees 20,000.3. However, the income which you have earned more than the amount which is subject to tax is just rupees 1. So because of earning 1 rupee more, you are going to pay tax of 20,000 rupees more, which is not right. That is the only reason why this marginal relief concept is there. Earlier, it was there for surcharge. It was not there for rates of tax because it will be similar only. But for surcharge, we had it. Now, in the new scheme of taxation, even for this rebate, the marginal relief is being given. Okay. This is in relation to rebate, and the till if your income is up to 7,27,770, you have to check if there is a marginal relief. So basically, what will happen is up to 7 lakhs, your tax will be nil. So from 7 lakhs to 7 lakhs 27,770, your total tax liability will not be more than the excess income which is being earned. Right? This is in relation to the marginal relief. Next is surcharge. So what is surcharge? So basically what will happen is your total tax liability plus, so from the total tax liability, you have to first add surcharge and then add the cess value. Okay. So it is going to be tax. After tax, on tax, you have to charge the surcharge. Tax rate, you have to charge the surcharge. So it is going to be like total income. From the total income, you will have total tax liability. In the total tax liability, which is based on rates of tax, you have to add surcharge. You have to add surcharge. On tax plus surcharge, you have to add cess. Cess is going to be at 4% always. Okay. So if you see the rates of surcharge, so till 50 lakhs, there is no surcharge. From 50 lakhs to 1 crore, your surcharge is going to be 10%. 1 crore to 2 crore, surcharge is 15%. More than 2 crore, it is 25%. What you have to note here is for all income, including dividend, 111A, 112 and 112A, the surcharge shall not exceed 15%. Okay. That is one point which we have to remember. This may be tested in MCQs. Next is health and education sales. We have already seen this. This is in relation to the new tax regime. Now let us go to the old tax regime. Old tax regime, if you see, for normal citizen, so up to 2.5 lakhs, the tax is going to be nil. From 2.5 to 5 lakhs, your total tax rate is going to be 5%. 5 to 10 lakhs, it is going to be 20%. 10 lakhs and above, it is going to be 30%. So if you see here for 2.5 to 5 lakhs, your total income is going, total tax liability is going to be 12,500. So 5 lakhs to 10 lakhs, it is going to be 1,12,500. So here also what you can do is you can just use this simple formula to find out what is the total tax liability which has to be paid. Here the rates of rebate which is given under section 87A, it is up to 12,500 or under percentage of tax liability, and your income does not exceed 5 lakhs. So here you have a rebate only up to rupees 5 lakhs, and it is not up to rupees 7 lakhs. This is to be remembered. It is not 7 lakhs. 7 lakhs is only for new tax regime. Sorry, I just scribbled something. 7 lakhs. 7 lakhs, it is only for new tax regime. New tax regime, not applicable for old tax regime. Okay. Next is going to be surcharge. Surcharge rates are similar, but provided this 37% surcharge is not applicable in the new tax regime, it is there only in the old tax regime. So up to 50 lakhs here also it is nil. 50 lakhs to 1 crore it is 10%. 1 crore to 2 crore it is 15%. If you see here, up to 10 lakhs, 50 lakhs it is nil. 50 lakhs to 1 crore it is 10%. 1 crore to 2 crore it is 15%. And from 2 crores it is going to be 25%. Here if you see, same 0 to 50 nil. From 50 crores to 50 lakhs to 1 crore it is 10%. 1 crore to 2 crore it is 15%. Above 2 crore there the rate was blanket 25%. From here, but for here 2 to 5 it is 25. If your income is going to be more than 5 crores, you have the extra higher surcharge rate of 37%. This is only for the old tax regime, and it is not there for the new tax regime. This 37% surcharge rate, it is there only for the old tax regime, and it is not there for the new tax regime. Here also there's the same 15% cap on dividend, and all other 111A, 112 and 112A is applicable. Okay. Here also the rate of health and education cess is going to be 4%. This is for normal citizen. Now let us go for senior citizen and super senior citizen. So as you all know, senior citizen means a person who has 60 years of age. Here up to 3 lakhs, in normal it was 2.5, right? Here for senior citizen, it is up to 3 lakhs, it is nil. For 3 lakhs to 5 lakhs, it is going to be 5. From 5 lakhs to 10 lakhs, it is going to be 20. And more than 10 lakhs, it is going to be 30. Only this 50,000 limit is there. Like there it was 2.5. Here the basic exemption limit itself is 3. For super senior citizen, the rate up to 5 lakhs, it is going to be nil. 5 to 10, it is going to be 20. And 10 above, it is going to be 30. That is in relation to super senior citizen. What you have to also notice, in the new tax regime, there is no concept of senior citizen and super senior citizen. Only in old tax regime we have this concept of senior citizen and super senior citizen, but in the new tax regime we do not have that. Okay. Now let us go to the other amendments. So I'm not touching upon all the amendments. So wherever it is applicable, only those amendments I'm touching upon. Okay, so important amendments, whatever is going to be relevant for our examination, only those we will cover as of today. So this is not relevant, this is not relevant. So one thing which we have to remember is this buyback of shares. In case of buyback of shares, earlier it was taxable in the hands of the shareholder. Now that exemption has been withdrawn. Sorry, it was taxable in the hands of the company. Now that exemption has been withdrawn, and now it is taxable in the hands of the shareholder itself. It is being treated as dividend under section 222 of the Income Tax Act. Okay, this is one major thing. Now let us directly go into the amendments which are made to different heads of income. Okay, the first difference is that in case of if a person is going to opt for the new tax regime or the default tax regime, the standard deduction which is given under section 16(1)(a) is increased from 50,000 to 75,000. Okay, so earlier the standard deduction was 50,000. Now it is 75,000, but this is only applicable for a person who is choosing the default tax regime. The person who continues to be there at the old tax regime, he does not have this extended benefit of 25,000. Next in house property, there is no change. The third head of income is going to be profits and gains from business or profession. In this, there was one confusion as to from in which head of income, if I'm going to let out the house property, should that income be charged? there was few judgments in the Madras High Court, which traveled up to the Supreme Court, Chennai Properties and Investments and other things, where the question was, in case if I have a house property, and I am in the business of letting out the house property, I am in the business of letting out the house property. Now, should this income be charged under the head IHP, income from house property, or PGBP? Sorry, just give me a minute. Or PGBP. Hope my screen is visible, right? Can somebody please unmute and say?
Yes, sir.
Yeah. So should it be charged under the head house property or under the head PGBP was the question. What has happened is the Supreme Court settled this in favor of the assessees. They said that if you are going to have if you are in the business of letting out the house property, it should be charged under the income from house property. But now what the department has said is, it has been said, oh sorry, it is just the other way around. If I'm in the business of letting out the house property, the Supreme Court has clarified that it is to be charged under the head PGBP. What the government has now said is, nothing doing. If you are, even though you are in the business of letting out of house properties, it should be chargeable under the head income from house property and not under the head PGBP. So it is against the case of Chennai Properties and Investments case. I am having some problem. So it should be charged under the head income from house property. If I'm in the business of letting out the house property, yeah, I'm having some error in my system. Yeah, just a minute. Yeah. If I'm in the business of letting out of house property, it shall be charged under the head income from house property and not under the head PGB. This is what has been clarified by the government. Next is in relation to increase in deduction which is available for contribution to the new pension scheme under 80 CCT. As you all know, there are two pension schemes, old pension scheme and new pension scheme. New pension scheme was not highly accepted by the people, so they gave multiple relaxations to that. Now what they have done is, earlier the reduction was available if I make the payment up to 10% of my 10% of the salary as deduction, like contribution, that was available as deduction. Under, if I'm going to make the payment to new tax regime as an employer, if it is up to 10%, the deduction was allowed. More than 10%, if I'm going to contribute, that was not allowed as a reduction. But now what has happened is the government has increased this cap from 10% to 14%. That is another change. Next is in relation to section 37. As you all know, section 37 is a catch-all category for deductions under head PGBP. So here what has happened is, the government has clarified that if you are going to make any payment to settle any contravention which has happened, that amount is not eligible to be claimed as deduction. So just to give you a small backdrop, if I'm going to pay any amount which for any violation of the act, that amount was not allowed as deduction under section 37. The question was, if I'm going to settle a liability which is arising out of an act, should I say that the act has been overwhelmed? But now what the government has clarified is, you pay it under any name. If you are going to settle even any contravention, even that amount is not allowable as deduction under section 37. Next is this increase in limit of remuneration to working partners. So as you all know, if I'm going in case of a partnership firm, if the partnership deed allows, the partner can draw remuneration, but that is subject to the limits which is provided in the Income Tax Act. Okay, the earlier it said that up to rupees 3 lakhs, either 90% or 1,50,000 will be allowed as deduction from the firm. So whatever is allowed as deduction from the firm, only this amount is taxable in the hands of the partner, and whatever is disallowed here, it is exempt in the hands of the partner. So basically there is remuneration which is going to be paid. This remuneration, there are going to be two parts. First one is allowed, next one is not allowed. If it is allowed in the Income Tax Act, it is taxable in the hands of partner. If it is not allowed, it is not taxable. It is not taxable. Okay. Let me use this note. Okay. Just a minute here. I'm having some problem with my screen. Can you just allow me a minute? I'll just reshare my screen. Okay. Hope the screen is visible, right?
Yes, sir.
Yeah. So we were on this point. So basically there are two types. The first one is if the deduction, if the remuneration, there are two components. In remuneration, there are two components. One is allowed, next one is not allowed. If it is allowed as deduction in the hands of the firm, it is taxable in the hands of the partner. If it is not allowed in the hands of the firm, it is exempt in the hands of the partner. This is the backdrop. It is to be only once taxed. Okay, there is no question on that. Now what they have done is this limit, whatever has been provided for, has been revised, because these limits were introduced way long back and now those limits have been revised. So what they have done, earlier the limit was, in case of loss, you can claim a remuneration of up to rupees 1,50,000. So loss and up to for book profit of 3 lakhs, you were allowed to claim the remuneration of 1,50,000 put together. On the balance book profit, whatever you are earning, you were allowed to take 60% of the net profit as remuneration. So this 40B, whatever is there, it is for all the partners put together as a whole. It is not for a single partner. That between you people, you can decide however you want to determine or however you want to split that. Now what they have done is, this 1.5 lakh limit has been revised to 3 lakhs. That is the only change. And the first 3 lakhs has been made as first 6 lakhs. In case of loss, the firm, the partners can take a remuneration of 3 lakhs. On first 6 lakhs, they can take 90% of the book profit or 3 lakhs, whichever is higher. After the 6 lakh rupees, so 60% of the remaining book profit can be taken as the remuneration by all the partners. The way in which the book profits has to be computed, all those things, it is we are not discussing in this video for want of time. Next is removing reference in section 43D. This is not very important. Now let us go to the capital gains part. See, in this exam, expect a question from the capital gains chapter, because there has been a major overhaul in the way in which the capital gains are to be computed. Okay, from this for this assessment year 25-26 and this examination in June, expect a question in capital gains. Spend some good time in this. Don't ignore this chapter, because the entire methodology in which the capital gains has to be computed itself has gone into a change. There are multiple unanswered questions, and even the what to say, the returns are also capturing it, right? So this is not a very easy area, and it has gone a major overhaul. Okay, so whatever has been studied has to be changed off. So first, let us discuss as to what are the major changes. The first point is the holding period. As you all know, the capital gains, whether it is long term or short term, is determined based on the period you hold the capital asset. So there are two types of capital gains. One is short term capital gain and the other one is the long term capital gain. As far as short term capital gain is concerned, earlier there was no indexation benefit. In case of long term capital gain, in case of other than shares, indexation benefit was available. And for both, we had separate rates of taxation in 111A, 112 and 112A. 111A will say the rate for listed securities short term. 112 is for long term all assets. 112A is specifically for long term listed shares. Or to put it in a different terminology, the shares for which STT has been paid at the time of sale. Hope this is first clear. Now, earlier the period of holding for an asset to be classified as short term or long term was 3. It was in case of listed shares and securities, it was 12. In case of land and building and unlisted shares, it was 24. For all other assets, it was 36. Earlier, there were 3 parts: 12, 24, and 36. Now, what they have done is, this 36 has been removed. The third category has been removed on a whole, and now there are only 2 holding periods. In case of listed shares and securities, 12 months. All other assets, 24 months. So now what is being changed is unlisted debentures. Unlisted debentures, earlier the period was 36 months. Now here it is 24 months. That is the change. And all other assets, gold, ESOP shares, whatsoever it is, all other assets, it is being now moved from 36 months to 24 months. So now only there are 2 things. One is 12 months and the other one is the 24 months. This is first change in relation to holding period. So basically, if you see the entire picture of capital gains, what you have to do is, first you have to identify whether it is short term or long term. After identifying whether it is short term or long term, as per section 48, you have to compute the capital gains, and tax in that respect has to be computed in 111A, 112 and 112A. These are the 3 major points. So first point, holding period, we have covered. The second point is the computation mechanism. This computation mechanism, what has happened is, in case of long-term assets, people had indexation benefit. What do you mean by indexation benefit? Indexation benefit is nothing but, longer the period you hold, higher will be the cost of acquisition. Assume, for example, you have acquired a property on 10/1/2001. Okay, you acquired this property for 10 lakhs. Assuming this indexation benefit is not there, and you have sold that property today for 1000 lakhs, the deduction which you will be eligible is only 10 lakhs. But is this even right? Because this 1000 lakh is based on prices in 2024. But this 10 lakhs is based on prices in 2001. What is this prices in 2024 and 2001? See, in 2001, the cost of gold, a sovereign of gold itself was somewhere around 10 or 12,000, I remember, if my memory serves right. But now it is somewhere around 70,000. So my purchasing power, whatever was there for 1 rupee in the year 2001, does not remain the same even in 2024. So my purchasing power of rupee 1 in 2001 is not the same as the purchasing power of that rupee in 2024. Even though the quantum is same, even though the quantum is expressed in rupees and the quantum is same, its value has substantially reduced. Its value has substantially reduced. So a 1 rupee of 2001 shall not be equated with 1 rupee of 2024. This is the entire concept. So what they say is, if you have purchased it in 2001 for 10 rupees, now multiply it with the cost inflation index. So all these changes in values, value of money is due to inflation. So what they say is, inflate the value of your cost of acquisition and then we'll compute the capital gain. This is the concept of indexation. See, if you see earlier, the concept of indexation was not there. There was a in 48.2 there was a 50 to 60% of standard deduction. This was somewhere in earlier periods. It was even before 1995. It was somewhere in 93, if my memory is 1988, somewhere around that period. After that, they brought in indexation. So once indexation was brought in, the base was again revised to 2001 base. Now what they have done is, they are doing away with this indexation benefit itself. So for all the properties which is sold after 23rd of July 2024, there is no indexation benefit. If you are going to acquire a property after 23rd of July 2024, there is no indexation benefit. But if the property is already acquired before 23rd of July 2024 and it is only transferred after 23rd of July 2024, the assessee has an option. The assessee has an option to opt either in for a method which has indexation or a method which does not have the indexation. Let me put it again. If the asset is acquired before 23rd of July 2024, and if the transfer is after 2024, 23rd of July 2024, the assessee has an option to choose whether he wants to take the indexation benefit or he does not want to take the indexation benefit. But there is a catch here. If you are going to go for the indexation benefit, the rate of tax is going to be 20%. If you are going to go for the indexation benefit, which is given under section 48 proviso, your rate of tax is going to be 20%. But if you are going to opt for if you are not going to opt for indexation benefit, the rate of tax is going to be 12.5%. The rate of tax is going to be 12.5%. This is the entire concept. Okay. So now the assessee has an option whether to pay under the new tax capital gains regime. I'll just put it that way. It is either 12.5 without indexation benefit or 20% with indexation benefit. However, there are certain other conditions which has to be satisfied for this point. First one is, it is available only to a resident individual and HO. It is not available for company, AOP, BOI, and it is also not available for non-residents. This is applicable only for residents. Okay. Next, this is applicable only in case of land or building or both, and it is not applicable for others. It is applicable only for land or building or both, and it is not applicable for all types of properties. Third point is, it doesn't matter whether it is residential, commercial. That is not a problem, but it is applicable only for lands, buildings, or both. And the asset should have been acquired before 23rd of July 2024, and it is transferred after 23rd of July 2024. If all these conditions are satisfied, you are eligible to use the indexation benefit. Use indexation benefit. Use indexation benefit, and you can pay tax at 20%. However, if you choose not to take the indexation benefit, you can pay tax at 12.5%. Here, it is going to be total consideration minus cost of acquisition. Cost of acquisition. So whatever is going to be capital gains, on this pay tax at 12.5. This is for new capital gains tax regime. Hope this is clear. Is this clear first? Can somebody unmute and say?
Yes, sir.
Okay. Next change which has happened in this capital gains is the rate in 111A has been increased from 15% to 20%. So now if you see 111A rate, it is going to be 15%. 112 rate, it is going to be 12.5%. 112A, again it is going to be 12.5%. Wait, just let me write this down. Stop here. Yeah. If you see now, there are three rates. In 111A, the rate is going to be 15%. It is going to be 15%. This is for short-term capital gains on which STT is paid. For other short-term capital gains, other STCG, it is going to be at slab rates. In 112, the rate has been changed to 12.5%. Earlier, here it was 20%. 20 has been changed to 15. Earlier, here the rate was 20%. Sorry. This was at 10%. 10 has been increased to 15. Yeah, I'm sorry, I'm just blabbering something. 111A, the new rate is 20%. Old rate is 15%. Okay. 112, new rate is 12.5%. Old rate is 20%. 112A, old rate is 10%. Now it is 12.5%. Earlier, the exemption which was available for 112A was 1 lakh. Now it has been changed to 1,25,000. Okay. This is the entire rate change difference. So now what the rate is applicable is for 111A, which is for short-term capital gains on which STT is paid. The new rate is 20%. In 112, for all assets, long term, the rate is 12.5%. Next is 112A. It is for long term STT paid. Here it is 12.5%. Basic exemption for this alone is going to be 1,25,000. Okay. This is the new rates which is applicable for capital gains. Now let us get back to our discussion. So this is the change in rate. So as I've said, in capital gains, totally there are three changes. First change is in relation to the holding period. Second change is in relation to the manner of computation. Third one is in relation to rate. So we have discussed all those things. These are three very, very important things. And other things are very consequential amendments here. I'm not getting deep into it. Okay. Next is this income from other sources. As far as income from other sources is concerned, as I've already said, earlier buyback was taxable in the hands of the company. Now that has been removed and now it is taxable in the hands of the shareholder itself as dividend. 115 QA is not applicable. Next is this 56 to 7B. This is what they will call as angel taxation. This is called as angel taxation. Angel tax. No, this has been removed. Okay. Now this is removed. So since it is removed, I don't want to get into this discussion at all. Next is standard deductions for family pension. This was applicable. This angel tax, it was applicable only for companies. Okay, it was not for individuals. So it is not also relevant in the intermediate stage. Next is the standard deduction for family pension. If you see earlier, the standard deduction for salaries has also been increased. Now they have also increased it for family pension, which is taxable under their income from other sources. The standard deduction has been increased from 15,000 to 25,000. In salary, it was from 50 to 75. Salary, it was from 50 to 75. Here it is 15 to 25. The standard deduction here it is going to be 15 to 25. This is given under section 57. Okay. Next is this 80 CCD. So here if you see the employer's contribution in PGBP, they changed it from 10 to 14, right? Here also it has been changed from 10 to 14. Deduction under 80 CCD has been amended to state that up to 14% it is not taxable. Now again, all these other things are very consequential amendments. What they said is you cannot put the Aadhaar enrollment number for application of fund. You should only put the Aadhaar number. That is this change. Next is this point is not applicable. This is not very relevant for us. Next is this TDS. This is one important point. 192 2B. So earlier what was happening is, so income, whatever is there. So there will be, as you all know, in case of a salaried person, the entire TDS has to be deducted by the employer on my total income. So there will be two income which a employee will have. The first one is salary income. The other one is other income. Salary income and other income. As far as, wait, let us draw it here. Oh, this is not visible. So every employee is going to have two incomes. One is salary income. Employee, as you take for example, Sonu. Sonu has two incomes. One is salary and the other one is, for example, take interest. Okay. Now, in the it is the responsibility of the employer to deduct TDS on two things: salary. This is compulsory. Wherever the in case of interest, there is again two bifurcations. First one, if the employee is not indicating this to the, is not disclosing this to the employer, then no obligation is there on the employer's part. No obligation on the employer part to deduct the TDS. However, if Sonu says that I have this interest income, and if he discloses to employer, for which if you see the terminology which will be used in 192 will be may. If he discloses this to the employer has to deduct TDS. Has to deduct TDS even for this sum. And here the word which will be used is shall. So if the employee provides the details of his interest income to the employer compulsorily has to deduct the TDS. And this is going to be at rate of tax. This interest income will already be subjected to tax, or it will already be subjected to TDS in the hands of the payer, and he would have already deducted 10%. It is either going to be under 193 or 194A. In any of these sections, the employer would have already, sorry, not the employer, the payer of interest would have already deducted TDS. Now, the employer should deduct tax at the rate of tax. Assume, for example, he is under 30% slab rate. So he deducts 30%, and this 10% is also deducted. Earlier, there was no provision for the set-off of 10% with this 30%. It was not there. Now what they are doing is, if the employer gives these details, the employee gives these details to the employer can deduct this amount. So assume, for example, I have to pay 30,000. The employer has to pay TDS at 30,000 for this interest. And if already TDS is deducted for 10,000, he may take this credit and he may deduct only this 20,000. Okay. So earlier this set-off was not available, but now the set-off is being built. Now this option of being set-off is being given to the employers. This is a very good change in this aspect. Next is in relation this buyback. Since the taxability has been shifted, it is also now subject to 194 TDS deduction. So here they have clarified that 194J does not constitute work for the purpose of 194C. They are excluding 194C and 194J, and all the other amendments. This one will be important. So assume, for example, if you are going to transfer the property for more than 50 lakhs, you have to deduct TDS under 194 IA. Okay. Now what has happened is, earlier there was a confusion. Is this 50 lakhs quasi person or quasi property? Now they have said this is quasi property, not quasi person. And the rates in respect of multiple sections have been changed. This is to align this with 194C. So all these sections, it is somewhere related to contract only. So just to get out of this the other issues, they have just changed the rate. So in respect of 194DA commission, 194G, H, IB, and 194M, all these they have changed the rate from 5% to 2% to align with 194C. And in 194O, it is for e-commerce operator. Here also they have changed the rate to 0.1%. Next is in case of earlier for 194Q, there was not an option to seek LDC. Now they have included that. 194Q is that new section wherein you have to deduct TDS if your it is going to be more than purchases are going to be more than a certain limit, and that 0.1% purchase on goods TDS. Now that as they were eligible for seeking the TDS now, sorry, LDC now. This 206C1H also has been amended. 206C1H is in relation to this TCS, same point. just for knowledge and information purpose, this has been omitted by Finance Act 25, which is not applicable for exam. Okay. So this TCS for purchase of goods has been done away with, but that is not applicable for your exam. That is from that has been done with Finance Act 25. Even though that is applicable for assessment year 25-26 for a certain period, but that is not there for this point. Okay. Next is inclusion of taxes withheld outside India. This might not be very relevant for you. Next is 206C1F on notified goods. They said that if it, in case of certain goods, if your purchase value is going to be more than 10 lakhs, you have to deduct TCS. And this is this point or this widening of amber, this is very procedural. This is again procedural. This is not, there is no much change. This is again procedural. Thus, they have said that if the payment is, as you all know, there will be two interest categories: amount collected and not paid, amount not collected and not paid. Amount not collected and not paid, the interest rate will be 1%. Amount collected and not paid, the interest rate will be 1.5. So now that even for TCS, that rate has been increased. In case of, they have also notified that I can notify any person for TCS. Right. So with this, the entire discussion on amendments which is made in direct tax is complete. Okay. So we'll continue with indirect taxation shortly. So, hi all. So in this video, let us discuss about the amendments which is carried out through Finance Act 2024 in relation to GST. In the earlier video, which has been already uploaded, you could see that we have discussed the amendments in relation to income tax, and in this we'll discuss the amendments in relation to GST. Generally, in CMA examinations, we find that majority of the portion is being covered by income tax, and only a smaller portion, even from the scoring angle, is done from the GST side. So we'll not go as deep as we do in income tax, but wherever required, we'll just give you the overview. The first amendment in Finance Act 2024, which is made in relation to GST, is that ISD has been made mandatory from 1/4/2025. Okay, before that it was an option. There was an option between cross charge and so there were two options which was available. Okay, it was either cross charge. Just a minute here. So they had an option of either cross charge or ISD. But now what they have done is they have done away with this cross charge concept, and whatever it is, you have to do it through ISD. So just to give you an overview of what this cross charge or ISD is, assume for example, I have a company in okay. Assume for example, I have a company A and Co. I have totally 24 branches across the country. Across the country. So my head office is located in Chennai. And this head office receives invoices for audit. Okay. So the ITC component which is involved, for example purpose, assume say for it is 24 lakhs. So this 24 lakhs of ITC, it is not pertaining only to the Tamil Nadu registration. It is not pertaining only to the Tamil Nadu Chennai registration, and it is pertaining to all these 24 registrations across the country. So it is not right only for the Tamil Nadu registration to avail the credit for all these entities. So earlier what they were doing is they had two options. First one is ISD. So what they'll do is whatever the Tamil Nadu registration receives, they'll raise an invoice on ISD, and ISD will turn distribute this with all the recipients. The person who's receiving the service will raise an invoice on ISD, and ISD will distribute this to all the persons. Or this Chennai entity will itself raise an invoice to assume, for example, a unit in Kerala or Karnataka. They'll raise a tax invoice for transferring this credit. The question is whether this is right or wrong. Whether can they do it or not. There was confusion. There was no clarification till 24. The processes were left to do whatever they want. But from 1/4/2025, it has been made clear that only ISD mechanism has to be used. Only ISD mechanism has to be used, and there is no concept of cross-charge mechanism from 1/4/2025 in the GST law itself. They have done away with. So for that, they have made few amendments. They have changed the definition of what do you mean by an ISD, and the manner of distribution of credit has also been changed. So this is the crux of this both the amendments. Okay. Next amendment is section 9. They have amended to take the denaturated extra neutral alcohol or rectified spirit, which is used for manufacture of alcoholic liquor for human consumption, out of the purview of CGST. As you all know, alcoholic liquor for human consumption is not under the purview of GST. Now they have also used that alcoholic liquor for like an undenaturated extra neutral alcohol or rectified spirit, which is used for manufacture of alcoholic liquor for human consumption, also out of the purview of CGST, which means out of the purview of GST itself. This section 74A is a new section. I'll just explain the background to this. This will be coming again and again. So what they have said is they have introduced a new section called, earlier what there were, this is in relation to all these assessment proceedings. Earlier there were two sections, section 73 and section 74. Section 73 is for normal cases, 74 is for fraud cases. Here generally the period was 3 years, generally. Here the period was 5 years. Now what they have done is, they have done away with this distinction of 73 and 74, and they have introduced a new section called as 74A, which is applicable for all the disputes from financial year 24-25. Okay. So now wherever the reference was earlier made to 73 and 74, now they are changing that reference to 74A. Okay. This is what is happening in multiple places. This is in relation to the second amendment. Third amendment is in relation to section 11A. So 11A is a new section which has been inserted, and by avoid this, they have given the power for the government to regularize non-levy or short levy of central tax due to any general practice which is prevalent in the trade. But this is a procedural amendment. There is no much impact of this on examinations per se. Maybe in once notification comes under 11A, maybe that will be relevant. But this one, as such, it is not relevant. Then section 13.3 has been amended. Under section 13.3, it will provide for the time of supply of services. Okay. So earlier, in case of invoices, which is there was no time limit within which the invoice has to be reversed for reverse charge basis by the recipient. Now they have introduced that time limit. Next is section 17.5 amendment. 17.5 deals with blocked credits. Okay. So 17.5, what they said is, as I've already said, 74A has been included. 74 is being removed. So since 74A has been is coming into force from 24-25, so up to financial year 23-24, only if the tax is paid under section 74, no ITC is available. So basically, section 17.5 deals with non-eligibility blocked credit. If ITC is paid under section 17.5, if ITC is paid pursuant to an investigation or audit under section 17.4, ITC is blocked under section 17.5. Okay. Now what they have done is, the 74 reference has been removed, and they have said that this is applicable only for up to financial year 23 to 24. This is what has been done by this amendment. Next is section 21, which deals with registration. Here also the reference to section 74A has been removed. Section 32 is a procedural amendment. Next is section 31(3)(f). So here, as I've said, in case of a recipient who has to raise the invoice under RCM basis, a time limit has been given, and there is also an enabling provision now in section 31(3) for him to raise the invoice. Okay. Again, section 35(6), they have just removed the reference to section 74A. Next is section 39(3) has been substituted. So wherein it is mandated that electronic furnishing of return by a registered person required to deduct TDS, irrespective of whether the deduction is made or not. So what they say is, in case of TDS returns, whether or not there is a deduction, you have to file the returns. They are mandating it. File the returns under section 39. Here in all these sections 49, 8, 50, 51, 50, 61, 62, in all these sections, they are removing the reference from 74 and they are replacing that with 74A. Next is Schedule 3 activities. Schedule 3 activities, no supply. And here, what is happening is, in case of co-insurance, reinsurance, they are removing that from the ambit of GST itself. This was an industry-wide issue as to who should pay the tax, who is not required to pay the tax. There was some huge confusion which was prevailing on, and now they said that in case of co-insurance and reinsurance, they are putting it under Schedule 3 transactions, right? Next is amendments in IGST Act. So here what they have said is in relation to section 16(4), which provides for a refund in case of zero rated supply. They have introduced in few new conditions. Customs, I'm just skipping it for the time being. I don't foresee much of that being tested in examination. And certain exemption entries, what has been amended is, this was not majorly through Finance Act. All these exemption entries were through notifications, and this was through GST Council meetings. And majorly, if you see, the reason why there are not much amendments in GST Act through Finance Act is because most of the amendments comes through GST Council discussions, circulars, and notifications. Only whatever has been recommended there is being done through the Finance Act. Okay. Next is in the what are the amendments which is made in the exemption notification. Here, if you see, whatever services is provided by Ministry of Railways to individuals by way of sale of platform tickets, facility of retiring room or waiting room, clock room, battery operated cars, all these things are now being said as exempted supplies. And a service which is provided by Ministry of Railways to another zone or division, that is being moved out. This 9G, it is very, very industry specific. So in case of an SPV of Ministry of Railways, that is also exempt from GST going forward. Next is services by way of renting of residential dwelling for use as residence. This is being covered. This is for residential dwelling for use as a residence is exempt. But this does not cover hostel services. Hostel services are taxable. Hostel service taxable. Hostel service are taxable. Next is supply of accommodation less than 20,000, it is taxable. Next is in relation to this, providing metering equipment for rent for electricity, that is exempt. Then this reinsurance, co-insurance thing, retroaction, like cross-border reinsurance, that is now being exempted. Next is this research and development. Research and development, earlier it was only, if it is only through government entity, it was exempted. Now what they have said is the research association, university, or other institution which is notified under 35(1)(2) or 3 of Income Tax Act, those people are also now eligible for exemption. And this was based on as is whereas basis. As is whereas the past demands has to be resolved. As is whereas basis means if you have paid lower rates of tax, that has to be accepted, but if you have paid higher rate of tax, you are not eligible for refund. That is just a one word definition of what do you mean by as is whereas basis. So they have also given some circulars and notifications to this respect. Right, next is service affiliation services, which is provided is been now exempt under entry 66A. and all these yojanas and all are now being exempt. So import of service by an establishment of a foreign company in India, which is an airline company, from a related person from outside India, when made without consideration, this is exempt, subject to other conditions. Next is amendments in reverse charge basis. So supply of metal scrap by unregistered person. Supply of metal scrap by unregistered person is now covered under reverse charge basis. And from 10/10/24, service of renting of immovable property other than residential dwelling by an unregistered person to a registered person is covered under reverse charge. So renting any immovable property, if there is any immovable property other than residential dwelling, so commercial property, if it is let out by unregistered person to registered person, now this registered person has to pay this under RC. Next is value of supply. Now what they have said is, as you all know, in case of value of supply, if a discount is being issued and a credit note is given, credit has to be reversed. Credit has to be reversed by the recipient of service. But there is no per se mechanism for the supplier to verify this. Supplier will issue the credit note, but how will he verify if the other person has not reversed the credit or not? That was the major problem. And now there is a portal based on IFF and other things that is happening. But for previous periods, what they have said is, so the supplier has to give a CA if the credit involved is more than 5 lakhs, he has to give a CA certificate. If not, he has to give an undertaking or certificate from the supplier. Sorry, the recipient. So the recipient has to give a undertaking or declaration to the supplier that in respect of such credit notes, the credit has been reversed. Credit has been reversed. So this has happened. Next is value of supply in case of corporate guarantee. Here what they have said is, if the recipient is eligible for full ITC, then the value, whatever is declared in the invoice, shall be deemed to be the full value of supply. So this 1% is not applicable if the recipient is eligible for full credit, right? Next is rule 47A. So where the recipient is required to issue the invoice. They have said that within 30 days of receipt of supply of goods or service, the recipient is required to give the invoice. Next, few changes in relation to the returns. The first one is GSTR 7. It is required to be submitted by the 10th of the subsequent calendar month. GSTR 4, it is required to be submitted annually by 30th of June. Next is this electronic credit ledger reference to section 9610, rule 9610 has been removed. And in GSTR 1, few references have been removed. The last 2 points are a bit important other than the first 4 points. So the first point is that the registered person, after furnishing the details of supply in form GSTR 1, and if before filing 3B, if he wants to amend any of the detail which is provided in GSTR 1, he may do that through GSTR 1A. So first you will file GSTR 1, and if you want to make some changes in that, you can make the changes in GSTR 1A before filing GSTR 3B. Okay. Next is that this is just a disclosure requirement. In GSTR 1, earlier, if you are going to make interstate supplies to unregistered persons, you are required to give invoice details if the invoice value is more than 2.5 lakhs. Now this limit has been increased to 1 lakh. This is the last amendment. So with this, the amendments in relation to GST is done, where the important amendments in relation to GST is done. So in the subsequent things, we'll discuss about the other questions and answers, wherein we'll discuss how to solve the questions, some important 30 questions, right? Thank you. Bye. We'll meet in the next video. Stop sharing. Continues.